Chapter 3. Risk and Ignorance. One oft-quoted axiom of investing holds that the secret to getting rich is less a matter of the killing you make on your investments and more about the avoidance of losses along the way. Or as the legendary Benjamin Graham, 1884 to 1976, put it in the last chapter of his renowned 1949 Bible of Investing, The Intelligent Investor, confronted with a challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. To that, let us add an apt one-liner from the inimitable Oracle of Omaha, the assiduously folksy financier Warren Buffett. Risk comes from not knowing what you're doing. On Wall Street, the level of risk increases exponentially, for we have more investing experts than ever before, dispensing financial advice to more investors than ever before, and the vast majority of them don't know how to manage risk and the nasty surprises it can entail. It is a startling and disturbing flaw that runs deep in even the biggest and best firms on Wall Street. This amounts to a stunning betrayal of the investor who has enough money to entrust to a financial advisor from Morgan Stanley or Goldman Sachs or any of the storied names you have heard for decades, names that evoke dollar signs and pinstripes and fancy suspenders, or braces, as we call them in the roaring 90s. The world's most revered names in investment banking are bad at detecting and deflecting risk for their clients, even clueless at times, and their lesser lights in smaller shops are even worse at it in many cases. It is an unforgivable sin, for risk is at the very foundation of all investing. It is one of the building blocks that dictate the design, direction, and development of most everything that follows in their wake. The seesawing balance between level of risk and level of returns is the key pivot point for all investing. If you want stellar returns that might have a chance of rising 40% in a year, you may require taking on immense risk that could trigger a loss of, say, 25% of your life's savings in a single swipe. Most of us are risk-averse when it comes to losing money. Studies show investors are 2.5 times more negative about losing money on an investment than they are happy about reaping a gain. And so we invest conservatively, willingly accepting lower returns to avoid the risk of losing bigly, as President Donald Trump would put it. Thus, bonds issued by the U.S. government pay lower interest rates to the bondholder than, say, utility bonds issued by a city or high-yield junk bonds issued by a corporation. This is because the U.S. bonds are viewed as safer, all but guaranteed to get paid back, while local governments can stumble and default. A corporation sometimes belly flops, therefore it must offer investors higher interest rates than they can get from government bonds, to reward them for taking on the higher risk that the company might never repay them. The risks of owning stock in a company run even higher. Thus, stocks must promise an extra upside in terms of a rising price or a dividend that exceeds the yield on a bond. Bond yields always exceeded dividend yields on stocks until about 10 years ago, when they crossed over and stocks' dividends rose higher than bond interest rates. Most stocks prefer growth over dividends, though, and that is the main reason to invest in stocks, for capital growth. In a corporate meltdown, the company's equity, the stock owned by shareholders in the firm, can get wiped out as the stock price falls to zero, as happens when companies file for reorganization under Chapter 11 of the Federal Bankruptcy Code. A total loss. Debt holders, by contrast, are the first in line to get paid as bankers sell off assets to raise money to repay bonds before deigning to meet any other obligations. Lenders come first, always. Owners come last. It has been this way for centuries of commerce. Art imitates life, the old saying goes, and so does investing. Just as you take bigger risks when you are younger and feel like you will live forever and don't know any better, so can you take bigger investment risks when you are younger and have years to make up any momentary swoon in the markets. Put another way, Just as you end up taking fewer risks on the ski slopes when you have passed a certain age and your joints can't take the pounding they once endured painlessly, so must you reduce the risks you take in investing as you get older and your time shortens for recovering from losses. Wall Street advisors, in evaluating their own performance on your behalf, often cite only one key question: how much did the total combined value of your assets rise in the previous 3 months? It is a terrible question, because it is the wrong question. You can have the highest returns in investing history, but that means nothing in the bigger picture. That's because performances mean nothing, and I mean nothing, unless it is evaluated in the context of risk. In a strong, robust market, as the old cliché has it, a rising tide lifts all boats. When everybody is up, the question becomes, how much risk did you have to take on in your portfolio to reap those rewards? How much protection did you have in place? How much in fees and costs did you have to cover? How much of your gains did you have to pay in taxes? And I'm talking over a period of 10 or 20 or 30 years, not just 1 quarter. That's what counts. Wall Street wealth managers barely speak in these terms because most don't know they should be doing so, and those who do know don't care. Broken portfolios. One can argue that fully 97.5% of all investment portfolios managed by Wall Street, we are talking trillions of dollars, are broken or inefficient and fail to measure up to investors' needs. This is because 97.5% of portfolios lack alternative investments, hedge funds, options, futures, precious metals, diamonds, luxury automobiles, perhaps even such exotica as baseball cards, up 17% a year over the past few decades. Without alternatives, it has all been impossible to significantly reduce the downside risk in a portfolio. When you invest, you should first have a sense of how much downside you can handle in a 12-month period. Say you invested $1 million, and by year end it had lost $100,000. Most people would say that is as much downside risk as they can handle. That is just a 20% dip over an entire year. Most investment portfolios at the Wall Street giants have a downside to upside range of minus 25% to plus 40%. That is, most portfolios have as much chance of falling 25% in a year as they do of rising 40% in a year, with the vast majority of accounts finishing up somewhere in between. Most financial advisors are unaware that their own model portfolios include this flawed proclivity for volatility. If you're lucky, your returns might at least match those of the broad stock indexes, such as the Dow and the S&P 500. If you are lucky. The fact is, most active fund managers who trade in and out of stocks and other assets, endeavoring to outfox the rest of the market, trail the broad indexes over the long term. Wise long-term investing requires a counterintuitive mix of unrelenting optimism and constant caution. Instead of thinking about how much money you will make in the next 12 months, which is what your broker wants you to focus on, you should be thinking about the probability of loss in the next 12 months. Your advisor should be talking to you about the worst that could happen and what that would mean in dollars and percentage. Probabilities are what matters when assessing risk. In order to have the freedom to live the way you want, you must understand risk. That's also true of the people who are supposed to be taking care of your life savings. Instead, you are beholden to people who don't ask these questions, who don't understand capital risk or other kinds of risk. They don't tell you that you might lose 18% this year and another 19% next year. At one point in my investing career, I had a good chat with a client named Cliff, and I asked him, if you looked at your portfolio and suddenly it was down by $200,000, how would you feel? Him, I wouldn't be able to sleep. Yet he had an account topping $10 million, so I told him, okay, Cliff, that means you can't handle being down 2%. So how do you expect me to get you 10% returns in a year if you can't handle being down only 2%? You never had thought of it that way. No risk, no reward. No pain, no gain. You get that, right? Everybody does, in theory. Suppose someone offers you $1 million to walk a tightrope. You think, wow, that would be great. $1 million just to walk a tightrope. Think of that as being solely focused on performance. All you have to do is make it across and you win. Most money managers think this way. All they have to do is make it to the end of the quarter with a return that beats the market, and they win. Except the next thing that comes to your mind is, wait, how high off the ground is that tightrope? That's where risk comes into play. If the tightrope were 1,000 feet off the ground, then you would be taking a gigantic risk, your life, to earn that $1 million return. That is not the kind of portfolio you want your broker to construct, because if there is a lot of risk and its value falls precipitously, you could lose it all, just like falling off that tightrope. Now suppose that tightrope is 1 foot off the ground. Then the deal is a no-brainer. That's a risk you would take every time. It also is something that never would happen, because nobody will give you $1 million to walk a tightrope 1 foot off the ground. They might give you $10, but you can't get something for nothing. So let's apply this to investing. If I told you I could design your portfolio so it had as much chance of returning up to 20% a year as it did of losing up to 25% in a year, would you take that chance? You should instantly know the answer is no way. This is how brokers and financial managers should be phrasing their questions, because this is what risk is all about. Investors get blinded by the potential upside. Say you visit 2 portfolio managers. The first can construct a portfolio that, based on past performance, could lose 20% in a year or rise as much as 40%, staying within that range 95% of the time. The second can construct a portfolio with the same 95% consistency that has a range of 6% to 14% a year. Which would you choose? You should choose the second manager every time. I would rather have a high probability that even in my worst year, I would still make money, 6%. And in my very best year, I'd beat the historical average of 10% by earning 14%. That's because there is a very low probability, only 5% of the time in the past, that I would do worse or even lose money. I gladly would forfeit any chance of earning 40% to avoid risking a loss of 20 to 25% in a year. So should you, by the way. Let's break it down further, starting with your imaginary $1 million portfolio. Suppose the first money manager you visited does great this year and earns 40% on your portfolio. At the end of the year, you have $1.4 million. The second year, however, he loses 20%, and you are down to $1.12 million. Meanwhile, let's say the second manager hits his top target of a 14% return on your portfolio in year 1, and the next year hits his downside low of 6%. You would end up with $1.224 million, which is 9% better than the first manager achieved in his 2 years. Who would you choose now? Which manager's portfolio would let you sleep better at night and feel better enduring high volatility days? Risk is a critical factor when constructing a portfolio because it is an emotional part of our lives. When things get bad, we tend to believe those bad times will continue. We imagine what will happen if things fail to improve. That's why you see people selling at the bottom. They get so afraid of losing even more than they have lost already that they sell out in a panic. Yet when things are going great and the market is way up, we don't think about preserving our gains. We don't even consider selling. It's as if we are at a craps table in Vegas. We're on a heater, and we want our investments to keep running. Our emotions get the better of us. That's always been true. Emotion creates volatility, which creates risk. The more emotional we get as investors, the more likely we are to buy or sell on a whim, which increases everyone's risk. CNBC, Fox Business, and all the 24-hour news channels are continually trying to generate emotion to get people to act. In a market meltdown, that can do a disservice to all investors, who are better off if they can learn to neutralize the natural knee-jerk reactions to the careening highs and lows that can accompany investing. Anticipation is preparation. Anticipation is preparation. If you know the kinds of risk that can threaten your portfolio and require you to respond urgently to sidestep the consequences, you are one step ahead of most of the pack. And I like the old joke about two pals getting chased by a hungry bear. You don't have to outrun the bear market, only the other guy, by beating him in the race to an undervalued safe haven. Most investors think of risk in a fairly simple way. Stocks are risky, bonds less so, and they might lose money that they invest in either one. That's about the extent of it. Most brokers and money managers don't bother to educate clients about the different types of risk that exist with different kinds of investments. To truly invest successfully, you have to understand all the risks that are out there. Your money manager must be able to discuss these risks with you and explain how to quantify them. Keep reading, and you won't need them anymore. You will learn to do it yourself. By my count, essentially 8 categories of risk loom over investing, and you must be aware of each and every one of them. Risk number 1. Inflation risk. This is the risk of erosion in your purchasing power. It is the most insidious, damaging risk of all, and the one that is hardest to predict. If your retirement account is growing 3% a year, and your food and housing costs are rising 12% a year, you are losing purchasing power at a desperate rate. Government statistics show that inflation has been rising at 2% or less a year for several years. In many parts of America, the cost of living is rising much faster than that. As we will later see, government statistics intentionally understate the real rise in the cost of living so as to reduce the COLA payments that Social Security must cover to keep pace with the official inflation rate. It amounts to a premeditated mass deception, and the implications of this understatement of the real rise in prices in your daily life are devastating. You first must get a grip on the real inflation in your life, how much the costs of your daily activities are increasing each year, before you can assess whether your portfolio is producing the returns you require to preserve your purchasing power. If you fail to do this, you could be one of the millions of people who commit a long, slow financial suicide, and they don't even know it. Risk number 2. Capital risk. This is the risk that the investments you bought will decrease in value from the prices you paid, causing you to lose money if you end up having to sell at the lower prices. In past financial crises, investors who panicked and sold at the bottom locked in their losses, even though asset values eventually rebounded and rose from there. Capital risk is twofold, actually. The first risk is that your asset value declines. The second is that you react unwisely out of fear and make the losses permanent. Risk number 3. Correlation risk. You may have heard that diversification of your portfolio is a good thing. This is because it helps you avoid correlation risk, or putting too many of your investment eggs in too few or too similar baskets. The challenge in today's global economy is finding truly non-correlated assets that operate oppositely to the main elements of your portfolio. While 20 years ago you could offset the risk of a plunge in U.S. stocks by buying stocks in major markets overseas, or even in smaller emerging markets more recently, today stocks trade in tandem across all of those markets. They all are correlated to one another, and you must search harder to find truly non-correlated against-the-grain hedges for your account. Risk number 4. Liquidity risk. This is the risk that you may be unable to convert your investment into cash if you need to raise capital fast. It exists mainly in private equity investments, real estate, venture capital, and some securities that rarely trade. When it comes to things like collectibles, antiques, diamonds, or exotic investments, you may be unable to sell them at all, just when you need to do so. Risk number 5. Horizon risk. This is a tricky category that can elude even a skilled wealth manager. When you invest your savings, you should plan on at least a 10-year window or time horizon. Markets and the wealth they create grow in jagged patterns, with plenty of ups and plenty of downs. Your investments will need time to recover from losses, and if you can wait long enough, most of the time they will. Over the truly long term, in a century or more of trading on the NYSE, stocks rose an average of 6% a year, despite down years and bear markets and cataclysmic crashes. What happens, though, if an emergency necessitates you sell after only 1 year, rather than waiting a decade for your investment to mature? Say you lose your job, or incur a huge medical expense not covered by insurance, if you even carry health insurance. You have to sell. But what if the market crashed 4 months earlier and your investments are down 30%? You sell and take the loss. The best way to handle horizon risk is to invest no more than you can afford to lose. It is a striking contradiction. Hoping to build wealth by using cash you can afford to burn. Here is another one. A longer time horizon in investing is a means to reduce risk. Yet for bondholders, the longer horizon increases risk. If you own an old government bond paying 2% a year, and new bonds of the same duration are paying 5%, you are losing out in a major way. This is why a 30-year government bond must pay a higher interest rate than, say, a 2-year government bond. You take on much higher risk by locking up your money for such a long period of time because you are unable to shift it to safer grounds in the event of market disruptions, global panics, recessions, and other forms of hell that can break loose at any time. When investors use a bond ladder to invest in a revolving array of bonds that mature at various times, short-term, every 6 months, medium-term, every 10 years, long-term, every 30 years, they are managing horizon risk. Risk number 6. Currency risk. More than half the profits of most multinational corporations these days are generated overseas. So even though you think you don't have any international investments, you do if you own the stock of a company that does business overseas, or you own mutual funds that own such stocks. When the U.S. dollar rises in value against rival currencies, such as the euro or the British pound, it can hurt the dollar earnings of U.S. titans back home. Starbucks is Seattle-based, but has thousands of stores abroad, with transactions conducted in local currencies. Buy a coffee at a Starbucks in Berlin, and you will pay in euros. In Budapest, you'll pay in Hungarian forint. When Starbucks adds up all its revenue from other countries using the currency of that country, it then has to convert the total into dollars. If the value of a local currency declines in relation to the U.S. dollar over a certain period of time, then when that local currency is converted back into dollars, the reported revenue and any associated profits will be lower than they otherwise would have been. Lower profits can lead to lower stock prices, because stock prices almost always follow earnings. I say almost always because of exceptions that prove the rule, such as Amazon, whose stock has soared over the past decade, even as the company's earnings have often been non-existent or eaten away by massive expansion projects and discount pricing. In the decade prior to March 2018, Amazon's earnings rose less than sixfold, yet its stock price rose almost 20-fold. Risk number 7. Credit risk. This is the risk every lender and bond buyer must contemplate when putting their cash on the table. What happens if I don't get paid back? This is what's known as credit risk, the risk that the credit extended to the company never gets repaid. So, if you have invested in company debt of some sort, you have to evaluate the credit risk of each and every investment you make. Standard & Poor's, Fitch Group, and Moody's Investor Service all built billion-dollar businesses by issuing credit ratings for corporate bond issues, local governments, and other concerns which assessed the likelihood that investors would be paid back without a problem. Fitch's ratings, for example, start at a high of AAA for large, financially strong companies likely to withstand any foreseeable event, then move down a notch to AA for those with a very low default risk, and so on, all the way down to the worst of the worst, or rather the riskiest of the risky, the lowly C, for companies in which the default or default-like process has begun or the issuer is in standstill. Risk number 8. Longevity risk. Bluntly stated, this is the risk that you outlive your savings. The longer you are alive, the greater the chance that you will run out of money. Retired investors who are earning a real rate of return that fails to keep up with the real increases in their personal cost of living, and who have no other regular income or savings, could run out of money before they die. It is doubtful that the government's Social Security program will make up the difference for many people. When Social Security payments commenced in 1940, the government promise was that payments would start at age 65 and continue for the rest of the recipient's life. But life expectancy was 61 for men and 65 for women. Just 9 million people were age 65 or older in 1950. Today, the average life expectancy in America is 76 for men, 81 for women, meaning payments must last for 10 to 15 years longer. Plus, some 50 million Americans are 65 or older. Every single day, another 10,000 baby boomers turn 65 and start receiving Social Security. The financial consequences of this influx are overwhelming and devastating. Worse, back when the Social Security program began, the U.S. had 6 workers paying into the retirement fund on behalf of every 1 retiree. Today, it is almost fewer than 3 workers for each retiree. The burden per worker has doubled, even as the government obligation has dramatically increased. The center will not hold. Social Security will go bankrupt or suffer massive cuts in payouts. You should assume the program will die before you do, and brace yourself to do without it. You may want to forfeit Social Security income altogether and make plans for your own financial future, because in the end, it will all be up to you. So many forms of risk exist, so many things that could come between you and your money. Add them all up, considering different variations at different points in time, and you have the range of possibilities for your portfolio. Calculating the range of possible outcomes based on past results is crucial to your investment planning. Narrow that range, and you cut down on volatility in your account. In the following chapter, you will learn more about how to do this. It entails getting comfortable with a nerdy, daunting mathematical term known as standard deviation.